Today we're putting the spotlight on Chinese outbound M&A activity. Mark Casey, who sits at the Deloitte China Desk, joins me at our desk right now. Thanks so much, Mark, for joining us this morning. Well, we're placing, as I say, the focus on China's outbound M&A focus areas today. What's the status as it stands right now on cross-border acquisitions emanating out of Greater China?
Alishia, it's a fascinating world, China outbound M&A. We've been studying this for probably 5 years now. And our collaboration with our Deloitte offices around the world has helped to gather this sort of data, which shows some really interesting messages for what Chinese party politics and where the capital is actually going around the world. What we're seeing in recent years, and in actual fact the last 18 months, right up to the recent data, which ends the first half of 2011, shows that Chinese capital outbound is still going to the place they're most comfortable with, which is Southeast Asia. It's a huge component of their capital flows. Obvious places include the US and Europe, but there's also some political tensions around that. We've seen some companies like Huawei struggling to get into the US, being blocked. Chinese creating some of their own policy issues around foreign investors coming into China too, a bit of a cat and mouse game. But Europe is still a beneficiary, but the biggest ones are Southeast Asia and, interestingly, Latin America. Latin America is getting lots and lots of capital, and old Africa is sitting there with just under 6% of the global capital into equities, into M&A deals specifically.
So why are we forming such a small part of that pie at this stage? Because it naturally implies, given what you said, that China's not comfortable with Africa.
You know what, I've been on the show before and I spoke about Africa being a battleground initially for foreign capital coming in here. But also the globe is a battleground for Chinese capital. And you know, we're bidding together with other territories, and we've got to actually show the something sustainable, something attractive from an investor point of view to the Chinese. Now, if you look at economic policies and practices and political stability or instability around Africa, we have an inherently higher risk profile than other territories. We have labour issues, we have a lack of tax incentives, we have a political will that exists at a point, but in substance beyond that, in terms of concessions, in terms of deal making, just isn't there. It just isn't there. Now in Africa it's a bit of a curate's egg. It's good in parts. So there's some countries benefit more than others. Angola has certainly benefited far more than South Africa. Nigeria's benefit far more. Kenya, as you may know, is becoming quickly the silicon savannah for the world.
So let's hone in on those territories that are getting it right, Mark. I mean, what are they doing that other territories aren't? Because, you know, the emphasis has got to be placed on deal making and the kind of structures that go along with those.
Let me give you an example. The president of Kenya announced recently that the internet is seen as a basic human right. And his government is going to do what it takes to create connectivity for all Kenyans at speeds which make the internet a really usable tool. Now, in contrast with, say, South Africa, where because of our political and economic policies, telecommunications is weak, our infrastructure is weak, our ability to connect to the internet is weak. We know that. The stats show us that all the time. We're probably a third the average broadband speed of the likes of a Kenya. That cripples all sorts of industries. It stops growth. It's a de-stimulant, or it's a reversal of what should be a stimulus in the economy.
And it erodes the cost imperative of actually doing business in a country.
Absolutely, very much so. Very much so.
Well, let's take a look at infrastructure then, because that is one of our big, big deficient or inefficiencies at this stage of the game. Are we making the right strides in that regard to entice this investment?
I think there are. It's interesting, if you look at Chinese investment in recent years, there was a lot in the banking sector. We saw the ICBC deal with Standard Bank. I'm not sure we're going to see much more investment in that territory. I think a lot more in the energy and resources space. And I don't mean mining and off-take arrangements. I'm talking about energy projects, building infrastructure for energy, renewable energy. We've actually recently won a landmark advisory engagement for a Chinese consortium in the energy space. We're going to see more of those here and across Africa. And for that, actually, I'm delighted, because it's a maturity that's starting to form here in terms of just offtake and buying into mining assets. We're now actually starting to move into renewable energy, which contributes towards sustainability.
But it also, once again, then limits those investments to a particular sector. you know, a sector where you've got an investor managing to make that investment in infrastructure, for example, where that investment in the overall sector, so in the gas or oil space in this case, would make sense because they've got the infrastructure that they've put in place that would make that investment lucrative. So what risk do we face in that regard? Because yes, the opportunity is there, but it also risks seeing investment flowing specifically into a particular sector of the African economy.
There are other capital flows which I'm delighted to say there are some green shoots. So together with Martin Davies, I think you know of the Frontier Advisor, he and I work very closely together. We're starting to see more deal flow in the technology space. If you look at companies like Huawei, ZTE, they are actually becoming the IT plumbing enabler for the continent. They are now connected to pretty much every mobile operator that there is. They're in the wireline area as well. And also consumer business. We've got 1 billion people in Africa. There's a burgeoning middle class now off the back of a growing economic manifesto in many mid-African territories. Burgeoning middle class means great opportunity for consumer business. The Walmart deal is not the only deal we're going to see in Africa of significance. And my guess is we're going to see some Chinese investors coming in to that territory as well.
As this activity ups itself, I mean, implications for South Africa's private equity industry, I mean, they would face an increased amount of foreign competition here.
Absolutely. We're actually starting to see less of the old window shopping, state-owned enterprise Chinese investors coming here on a fly, looking at trying to buy a couple of assets on a speculative basis. We're seeing a lot more savvy, club-type deals, arranged with sovereign wealth funds, Hong Kong private equity firms, a lot more capital raising, specifically for outbound investment into emerging market territories with higher risk profiles. So I think we're going to see a lot more private equity, foreign private equity deals in Africa competing with our domestic players, but they've got a lot more ammunition.
Yeah.
And also with government behind them, a lot of strategic imperatives for long-term sustainability. So I think there's a lot of potential for the future, but we've got to come to the party with a real, tangible, at the ground roots level, support for Chinese deal making following on from the government's commitments.
Well, let's leave it there. Mark, thanks so much for your time this morning.
Thank you,
of course,
Alishia.
Mark Casey sits at the Deloitte China Desk.